Losing $100 hurts about twice as much as winning $100 feels good. That's not a motivational quote. It's a measured ratio, roughly 2 to 1, and it's wired into how you experience every trade. Before we go further, this is educational commentary, not personalized financial advice. What I want to do today is show you the exact mechanism by which that one number wrecks your exits, and why your P and L pays for it every single week. Here's the misconception almost every retail trader holds. You think your problem is picking bad entries. You think if you just found better setups, the account would grow. So you buy more indicators, more courses, more signals. But watch what actually happens to a trader who's right more than half the time and still bleeds money. The leak isn't the entry, it's the door on the way out. Let me prove it on the simplest case. 2 trades, same size, $100 of risk each. Trade A moves in your favor and shows a $50 profit. Trade B moves against you and shows a $50 loss. Now ask yourself, honestly, which position are you more tempted to close right now? Almost everyone wants to close the winner and hold the loser. That's the whole disease in one sentence. Why does that happen? Because of the 2 to 1 asymmetry. When you're up 50, taking the gain feels good, but the fear of giving it back looms twice as large, so you grab the certain profit. When you're down 50, locking the loss triggers that same doubled pain, so your brain refuses. It says, let it come back to break-even. You are not choosing based on probability. You're choosing based on which action hurts less in the next 30 seconds. This has a name from Kahneman and Tversky's prospect theory. People are risk-averse when they're in profit and risk-seeking when they're in loss. Flip that sentence around, and you get the exact opposite of every trading rule ever written. The rules say cut losses short and let winners run. Your loss aversion tells you to cut winners short and let losses run. You are hardwired to do the wrong thing, and it feels like caution. Now let's put numbers on the damage. Say your average winner runs to plus 200 if you let it, but loss aversion makes you close at plus 70. And say your average loser should be cut at minus 100, but you hold it hoping for break-even and it settles at minus 170. Your setup had a beautiful 2 to 1 reward-to-risk ratio. Your behavior just flipped it to worse than 1 to 2. Same trades, same signals. You converted a winning system into a losing one with nothing but emotion. Here's the aha. The market doesn't pay you for being right. It pays you for the size of your rights versus the size of your wrongs. A trader who's correct 40% of the time but wins 3 when right and loses 1 when wrong crushes a trader who's correct 70% of the time but wins 1 and loses 3. Loss aversion attacks the exact variable that matters most, and it hides behind the feeling of playing it safe. Watch how this shows up on a real intraday chart using SPY as an illustration, not a recommendation. You enter a long. It moves up half a point and stalls. The 2 to 1 pain of giving that back kicks in and you close for a scalp. 20 minutes later, it's run 3 times your target without you. Meanwhile, the trade that went red immediately, the one you should have honored your stop on, you're still holding at lunch, telling yourself the level will hold. That's not 2 mistakes. It's one bias wearing 2 masks. There's a second-order trap here, too. Every time you close a winner early and it keeps running, you feel regret. Every time you hold a loser and it comes back to break-even, you feel relief and reinforcement. So the market occasionally rewards the bad habit, which cements it. Intermittent reinforcement is exactly how you build an addiction. Your worst behavior gets trained by your best luck. So what does a disciplined trader actually do? First, you decide the exit before you feel anything. The moment of entry is the only moment you're rational about that position because you have no unrealized profit or loss to defend yet. Write the stop and the target down in the ticket before the trade is live. You are pre-committing while you're still sane. Second, you make the 2 exits symmetric with your edge, not with your feelings. If your analysis says the reward is twice the risk, then your target sits twice as far as your stop, and you do not touch either one because a candle scared you. The whole point is to remove the in-the-moment decision, because the in-the-moment decision is where the 2 to 1 bias lives. Third, you shrink the pain itself by shrinking the size. Loss aversion scales with how much a loss threatens you. If a single trade risks 2% of your account, the fear is manageable and you can follow the plan. If it risks 20%, the doubled pain becomes unbearable and you'll break every rule to make it stop. Position sizing isn't just math. It's how you keep your own psychology inside the range where discipline is even possible. And here's where this transfers well beyond day trading. Loss aversion is why investors hold a broken stock for years waiting to get back to break-even. It's why people won't sell a house below what they paid, even when the neighborhood has changed. It's why you keep a subscription, a job, a relationship, long past the point the numbers made sense. The break-even you're clinging to is a story about the past. The market only prices the future. So the durable handle, the one line to say to yourself at the screen: you are not managing a trade, you are managing a feeling, so decide the exit before the feeling arrives. Say that back the next time your finger hovers over the button. If this reframed how you think about your own exits, subscribe. Paragon Signals is about signal, not hype, and we go one clear idea deep every time. One last number to leave you with: you don't need a better entry to fix a losing account. If you simply stopped letting loss aversion flip your reward-to-risk ratio, the same signals you already trade could change sign, from red to green, without a single new indicator. That's the leverage hiding in your own behavior. Trade the plan, not the pain.